Thanks for joining us for our Ag Outlook webinar. I'm Jim Minter, Director of the Purdue Center for Commercial Agriculture. And joining me today is my colleague, Dr. Michael Langemeyer, who's the Associate Director of the Center and also a Professor of Ag Economics here at Purdue. We're going to talk a little bit about the Ag Outlook situation here with a little broader perspective than we sometimes do. We're going to start off by talking about what's taking place in the livestock and meat sector just a bit to kind of set the stage for what's taking place in the crop sector. So with that, I'm going to kick it off by showing a chart of beef and pork production. This is weekly beef and pork production combined from the federally inspected plants as reported by USDA. The red dots on the chart represent the weekly estimates for 2020, and that line on there is the 5-year average, and the bars are from last year. And so you can see the sharp decline that took place in red meat production during the month of April. Notice the last dot on that chart is kind of the preliminary estimate for this week. USDA publishes daily data for this week. We don't have the weekly estimate yet, but based on the first 4 days of this week, it looks like maybe we have turned the corner with respect to the production cutbacks taking place because of the plant shutdowns and plant slowdowns around the country. So that would be good news if that in fact is the case, and maybe see some confirmation here over the next couple of weeks if we start to see some plants open up with revised operating procedures. But that's been one of the keys, has been this dramatic decline in red meat production.
I think also, Jim, on that slide, one of the things that's very interesting is how high 2020 was until late March. That means the animals are out there.
Yeah, that's a good point. In fact, coming into this year, we were looking at record large meat production in the U.S. across all species. And as you indicated, those early dots from early 2020 indicate that it in fact was the case.
And I want to make sure we make a point of that, because we're going to show corn feed demand. And the only way to make sense of the corn feed demand is to look at that.
To think about those numbers. That's exactly right. And I guess the other thing is, Michael, sometimes people like to focus on the week-to-week drops. I like to look at the percentage change relative to last year. And if you look at the data for this week, I think beef production the first 4 days of this week was probably down about 25% compared to a year ago. Pork production down about 20% compared to a year ago. So keep that in mind as we go forward. The poultry side has been different, though. The poultry side did suffer a significant decline from that kind of late February, early March time frame until about the middle of April, and then actually has rebounded. In the last couple of weeks, we've seen poultry production pretty close to year-ago levels and actually slightly above the 5-year average. So the poultry production numbers have been quite a bit different, and they have really kind of served as a kind of a buffer with respect to the change in meat supplies that we've seen in recent weeks. One of the headline stories that floats around a lot is this idea that we're going to have a meat shortage. And I guess one of the topics I wanted to address today is the idea that we're really not facing a meat shortage. We are facing a shift relative to expectations and relative to last year. This slide has the estimated supplies that are available at retail level. And I want to maybe illuminate that just a little bit. If you think about what takes place, we don't actually know what people consume. What we do know is what the industry produces and ultimately distributes to consumers, a net of imports and exports, and that's what this data is. So it's effectively red meat and poultry supplies available to U.S. consumers. And as you look at it coming into this year, we were expecting to see record high meat supplies at the retail level. USDA, on this most recent World Supply Demand estimate released earlier this week, revised those numbers down to reflect the reduced production levels we've been experiencing here lately and anticipating some further reductions going forward. But notice as you look at those supply numbers on an annual basis where we are relative to history. It's not record large, but it's one of the largest meat supply situations we've had over the last roughly 30 years. So, and if you look at it, going forward, as recently as 12, 13, and 14, we had meat supplies on a per capita basis that were between 200 and 205 pounds per capita. USDA's estimate currently is about 217 pounds per capita. I suspect that number could come down a little bit as we go forward here. I think a few people in the industry think that that could be down in that 205 or less range. But nevertheless, that's not a true meat shortage, but it does imply different availability of product as you think about it, and it does put us in a situation where at any given point in time you walk into a grocery store with thought in mind about what cut you want to pick up. that cut might not be available on that day in that grocery store. And I think people are sometimes maybe confusing that with a meat shortage. It's more like a distributional aspect with respect to whether or not people can pick up the product that they were used to getting on a moment's notice, I guess is how I would think of that. Let's take a look at the prices a little bit. These are the wholesale pork values. Those have really taken off recently as pork production declined. So we've seen a big move. Initially, those prices dropped, and that was because of the reduction in demand that was taking place at the hotel, restaurant, institutional level. But as you see in the slide there, as we got into about the middle of April, we started to see those prices recover, and now we're well above both last year's level and the 5-year average. If you look at hog prices, the recovery got going in hog prices a little bit later, but we've seen a substantial improvement in hog prices. These are the base slaughter hog prices on a national average reporting basis. And notice that in the recent weeks, we've climbed back from a level of about $50 a hundredweight to about $70 a hundredweight. So that's about a 40% improvement just in the last several weeks. So we're not back to where we were this time last year. We're not back to the 5-year average, but it is a substantial improvement and narrowing that gap between wholesale prices and live animal prices. On the beef side, that looks like a little bit like a hockey stick to me, Michael. I mean, the box beef cutout value has really taken off these last roughly 3 weeks. And so it's been interesting to see the surge in demand. Obviously, a lot of that is driven by the supply situation. It also suggests, though, maybe stronger demand than I might have expected given what's taken place with respect to income and employment. So that's a little bit of a surprise to see as much strength as we're seeing in that box beef cutout value. And given the change in distribution across the different product lines. So very interesting. I didn't put this chart in, but if you look at the Choice Select spread, it's also been interesting to watch that Choice Select spread improve on a seasonal basis. In fact, it's matching the seasonal pattern, which again is a little bit surprising given the loss of income that we're experiencing, the loss of employment, to see that Choice Select premium.
I know this is a really tough question, but I'm going to ask it anyway. How long is that likely to persist?
The Choice Select?
That hockey stick.
Well, that's a great question. So it is a tough one to answer.
Very tough.
And obviously a lot of that is hinged on whether or not we see the beef production numbers really start to pick up. And as I mentioned a minute ago, this week looks like beef production down about 25% compared to the same week a year ago. We're going to need to see that gap narrow. That's probably the main thing, Michael. I think the other thing, though, that is interesting is this play that's taking place on the Choice Select spread, because there are really a couple of things going on in that Choice Select spread. Part of it's supply of choice, and part of it is on the demand side. And the fact that that spread is improving seasonally suggests that we're not holding back so many cattle that they're getting overfinished, which I think is always one of the concerns when you have a slowdown in the marketing pace. So very interesting in terms of how that's shaken out. But it does suggest if we see the beef production numbers bounce back over the next month, we'll probably see that choice box beef cutout start to back off substantially. Cattle prices have been a little slower to recover. And of course, that's been controversial this week with the introduction of the bill in the Senate talking about how beef processors can acquire their live animal supplies. Very interesting, though, that we have seen that live animal price come up about $10. These are the Southern Plains prices, so up about $10 since bottoming out in April. That's not nearly as big of an improvement in price as what we saw in that wholesale value, so a lot of room for improvement in terms of reflecting that improvement in wholesale values before we go forward. So kind of to wrap up the meat supply situation, I think one of the reasons we wanted to talk about this was just because there's this controversy with respect to what's going on in the meats, in meat production and meat prices. But the other one, as you pointed out, Michael, is the fact that coming into this year, we had record large expectations for meat production, and that had strong implications for feed demand. And we're going to talk about that here in a bit as we kind of transition into what's taking place on the corn side. So these, again, coming off of USDA's World Ag Supply Demand estimates that they released a few days ago. U.S. corn production forecast at about 16 billion bushels, a record large. Parenthetically, that's a little bit larger than the forecast we put together back on April 1, right, Michael?
Yeah.
But we did look at a big number. We were well above 15 billion, but not quite all the way to 16 billion. And part of that hinges on whether or not farmers actually wind up following their planting intentions. USDA in their forecast follow the planting intentions report exactly, and use that with trend yields to come up with that 16 billion bushels. We'll talk a little later about whether or not we really think we're going to see the acreage numbers that farmers were intending to plant. On the soybean side, over 4 billion bushels. That's in the ballpark of what we were suggesting a few weeks ago. As we rebound, big jump in acreage from last year, and then obviously a return to trend yield. That would push soybean production up 16% compared to last year. So big supply numbers. Let's visit the acreage a little bit. So here's the corn planted acreage estimate. 97 million acres is what came off of that planting intentions report. 2/3 of corn acreage is estimated to have been planted as of this past Sunday based on the USDA's crop progress report. But the question is, are we going to see some adjustment going forward? And I think you're going to talk about that later, Michael, but what's your gut feel?
And first of all, you go into that corn acreage, they don't actually count the acres when they do that survey. They just say, in my area, it appears that half of the corn is planted. And so there's no acreage estimates, so that's very important to understand that. But as we were talking earlier, Jim, I think that corn estimate is too high. I would not be surprised at all if it's not 1 to 2 million acres less.
Yeah, so, and I think last month we actually, in our estimates, used 1 million acres less on corn and 1 million acres more on soybeans, and we'll talk more about that.
Yeah, we're going to talk about the soybean to corn ratio, and I think that's going to illustrate that corn acreage could come down a little bit from 97 million.
On the soybean side, USDA is forecasting 83.5 million acres of soybeans based on the planting intentions report. Roughly, not quite, but almost 40% of the soybean acreage was reported to have been planted as of Sunday, and again, as you indicate, that's an estimate of what people thought was going in or was intended for soybeans. Still leaves some room for changes, and I guess that's the key point as we go forward here. There's an opportunity to make some changes. And I guess the other thing we should mention, Michael, is with the weather conditions we've had recently, sounds like there's probably going to be some corn and some soybeans that get replanted. We don't have a grip yet on what the magnitude of that is. I think a lot of people are still assessing damage or potential damage, but there's probably going to be some throughout much of the Corn Belt that gets planted because of the extremely cold weather we've had, and in particular some frost damage. So that's still a little bit of a wild card. So let's kind of think about this a little bit. March planting intentions, corn 97 million acres, 83.5 million acres on soybeans, but conditions have changed since that March 1 survey date for the planting intentions report. And I think one of the big questions going forward is, will farmers alter their plans from those March intentions? And you've taken a look at the soybean to corn price ratio, Michael.
Yeah, this is amazing. How much this has changed since February and March. Until about the middle of March, we were looking at a ratio of about 2.4. Long term, looking at it several years worth of data, which are not on here, that ratio runs about 2.5 or has run about 2.5, sometimes a little lower, sometimes a little higher. But here we're illustrating the huge change. We went from about under 2.3 in January and early February, all the way to the most recent estimate over 2.8. So that just makes a huge change in the relative profitability, corn versus soybeans in favor of soybeans.
There have been some anecdotal reports about people doing some switching. We've picked up some of that as well. You're going to show us a little later the budgets. It really does make sense, and if you haven't thought about this, it's probably something you want to think about, at least on some of those remaining acres. So let's talk a little bit about the demand side for corn, and really the question there is, how long will this weak demand environment that we're in persist? And on the corn side, it's really about ethanol, exports, and feed demand, and pretty much in that order. So let's take a look at it real quickly. Let's take a look at the ethanol side. Here's the estimated daily ethanol plant margins. This is based on some data from Iowa State University. They published this going back a number of years now. And it's interesting to see how negative those margins got in late March, beginning of April. And notice the improvement, though. We bottomed out on a daily basis at a negative 12 cents per gallon of ethanol produced. The most recent data, which I had, was through last Friday, a positive 16 cents. And if you look back to an environment where we actually had some pretty good margins, which was that late November, early December timeframe, we were at positive 36 cents a gallon. So You know, the question I think going forward is, are we going to see some continued improvement in that ethanol margin? If we are, that's going to have a significant impact on ethanol plant operations. Many of those plants, of course, have been shut down because of the poor margin situation. How rapidly some of those plants come back, what that does to demand, and then I think you also mentioned the impact that potentially has on DDGs.
Yeah, one of the things that's happened with the weak ethanol demand and some of the plants not running at capacity, maybe even in some cases shutting down, is there's no DDGs. If the plant's not running, there's no DDGs, and so one of the things that we've seen during this recent period is DDGs are extremely high, fairly high price compared to corn. Corn and soybean meal, if you look at those relationships, and so maybe as we start to gear up the ethanol production again, the DDG prices will be relatively lower.
Yeah, and I think it's going to be very
and
interesting.
also available. I mean, we've talked about that before, where in some cases there's not even DDGs available to some producers. You have had to change rations, and that's very important as we think about corn demand, because that obviously plays into demand for corn for feed.
Yeah, and we've seen that a lot here in Indiana, right? Because we're a big ethanol state, big ethanol producers, so it's had a big impact. Going forward, it's going to be very interesting to see, as the economy starts to open up around the nation, what happens to demand for gasoline. Does gasoline usage start to climb? And in turn, does that generate some demand for ethanol? And we're going to be monitoring those ethanol plant margins pretty carefully. Obviously, that would be huge to see those ethanol plants come back online, and we'll talk a little bit more about that later. So these are the ethanol numbers. So USDA did reduce their estimate of bushels of corn going into ethanol here in the 2019 crop year. They were well above 5 billion bushels coming into this report. They dropped it back below 5 billion bushels, and probably in the ballpark of what we were expecting, I think, there. The surprising thing, though, is you look at their first estimates for the 2020 crop year, they've got that ethanol demand bumping back up, not all the way to where it was in 2018, but not too far below it. Not too far below it, which implies a recovery in the U.S. economy, in particular as you go through the rest of, particularly into the fourth quarter of 2020 and then in the early part of 2021. So I guess how I would characterize that's maybe a little more optimistic about ethanol demand for coming out of the 2020 crop than I think I am, and maybe you are as well.
Yeah, I think it's more optimistic. I think it would be higher than 5, and so maybe something more like 5.1 would seem to me to be a possible guesstimate.
Yeah, so it is one of the wild cards, though, in terms of how much corn goes into ethanol. It's going to have a big impact with respect to the corn carryover with this big crop coming on. And this is a chart from the crop basis tool that we maintain on the Center for Commercial Agriculture's website. Nathan Thompson, a faculty member on our department who kind of maintains this, updated this morning. So this is basis levels as of Wednesday of this week, and notice the collapse in basis that's taken place since really the beginning of March. And that's about the time the ethanol plant margins really started to collapse. We started to see those plants slow down and actually started to see the shutdowns take place. Notice that basis level has, instead of being well above the 3-year average, is now basically either at or maybe a touch below the 3-year average. This week is actually pretty much right on the 3-year average. Last week it was just a touch below. And I think it's going to be interesting to see what happens there. If we're going to see an improvement in basis, it's going to have to come about, in my opinion, from the ethanol plants coming back online.
Let's talk a little bit about cash prices also from early this year to the current period. And one of the things that was occurring from January through at least mid-March is there was a pretty big difference between corn prices in the Eastern Corn Belt and the Western Corn Belt, 40-50 cents. In a lot of cases where the Eastern Corn Belt prices were 40-50 cents higher because of our short supply last year. That's pretty much disappeared. There's still a little bit of difference there, but it's not 40-50 cents. It's more like 10 to 15 cents, and so that's very important when you start looking at cash prices in the Eastern Corn Belt.
Yeah, and that chart pretty much tells the story, right?
Pretty much tells it.
It was the basis that was doing that, and we've lost that premium. And if those ethanol plants come back online in a big way, my guess is we could see basis levels move back above that 3-year average, but we're probably not going to get back to the premium that we were looking at in late February.
How long
and
would that
March.
last, Jim? If it did strengthen a little bit, that would disappear as we moved into the fall, correct?
Yeah, exactly. As we get closer and closer to that big crop coming on, assuming we have normal weather conditions this summer, I would expect that to erode. And I thinking of basis, I've worked with Nathan Thompson on some basis models and one of his former graduate students, Aaron Edwards. And one of the things we've learned over time is it's tough to forecast basis in the summer. You get that swing going on with respect to how tight old crop supplies are and the expectations for new crop supplies, and makes basis forecasts very, very difficult during that time frame. But having said that, if we see those ethanol plants come back online, I would expect to see some basis improvements. So we'll see how that shakes out. On the export side, USDA did reduce their export numbers as well. They've got the 2019 crop exports falling about 14% below 2018, and then expectation that they would rebound in the 2020 crop year. That implies demand recovery in those importing countries, and the other thing it implies is we're actually running behind the pace we would need to achieve even the 2019 forecast. So we're going to need to see exports pick up significantly here over the next 3 months to even hit that 1.78 billion bushels of exports that they projected for 2019 crop. And then as you think about the 2020, they've got that above the 2018 estimate, still below the 2017 estimate, but nevertheless, that implies economic recovery in those importing countries, because those corn imports in those importing countries are going to livestock sectors to fuel demand or satiate demand for animal protein in people's diets. With loss in income, I'm expecting weaker demand there, so I think there's some risk that we could have some trouble hitting.
And some of the countries we export have been hit pretty hard with COVID-19, and the timing of their incidence of COVID-19 may not match ours, and so I think that's going to play into those export numbers.
So again, I think we're a little less optimistic about the recovery in exports than USDA is. I'm a little less optimistic that we're going to hit this year's target, and I'm a little less optimistic than they are about the 2020 numbers as well. USDA is projecting some pretty strong feed demand for both the 2019 and the 2020 crops. This one we're probably don't quibble with too much, maybe a little bit on the 2020 side, but not so much on the 2019. And Michael, you were thinking about that with respect to animals.
Yeah, I think it just reflects the fact that we have a lot of animals out there on feed. Just because the slaughter number's down, that's down because because of COVID-19 and packing plant capacity issues. Once those packing plants get online, we're going to see those slaughter numbers increase because there is quite a few animals on feed. But I think part of what's also going on here is the fact that DDG production was down quite a bit, and so we're having to substitute more corn into rations, and I think that's reflected here in the estimates for 2019 certainly, and perhaps somewhat in the 2020 numbers.
Although given the optimism that they had about ethanol,
probably not so much in the 2020
not so much in the
numbers.
2020, at least
because that's a 2021 marketing year, that 20 number.
So again, we're a little bit concerned that the estimates might be a little on the high side with respect to usage. So let's kind of summarize.
You sound fairly pessimistic here, Jim.
Yeah, I'm having trouble getting real optimistic here. So corn production in 2020 likely to set a new record. Ethanol demand collapsed. How rapidly will it recover? I think the good news is we are seeing an improvement in those margins, and if the economy opens up and we see more driving taking place, I think that's good news for ethanol and actually corn demand. Exports currently forecast for the 2019 year to fall 14% below 2018. Based on what's happened so far, we need to do some catch up here these next 3 months, and I think that's going to be hard to do. So I'm a little concerned that the exports might fall a little bit more than that 14% USDA is currently projecting. And then as you look at the 2020 crop year, a 21% increase in exports strikes me as optimistic. And I guess that's really driven by the fact that we're concerned about the recovery in the world economy and that lingering not only through the fall of 2020, but lingering into the 2021 calendar year. So The big question marks really surround that rate of export recovery and ethanol usage. So let's take a look at the ending stocks and prices that USDA is projecting. So they've got ending stocks at the end of the 19 marketing year, the end of August, at 15% of usage. I think that's pretty close to where we thought they'd wind up a few weeks ago when we did our April 1 webinar, Michael. But as you look at 2020, seeing that carryover really bump up to 22%, and that's pretty negative. And so as you look at the prices, they did drop their forecasted price for the marketing year average for 2019 to $3.60. The 2020 forecast they put out was $3.20, so that's a 40-cent drop. And if we're right, if they're a little too optimistic about the usage numbers, I think we're a little bit concerned that it might actually be a little lower than 320.
And I want to use this slide to talk about long-run budgets. When you're putting together long-run budgets, when you look at this slide and you see all those red bars from 2014 on, 12% or above, several of the years 15% or above, and then you look at the prices, and we're well below $4. And so when you're thinking about putting together long-run budgets, you're thinking about cash rent negotiations. I think if you plug in $3.50 corn, that's not that pessimistic, and that's probably more realistic than anything closer to $4 corn.
And if you look at it historically here in the Eastern Corn Belt in Indiana, take a historical basis and look at that 320, even the 350 might be just a touch optimistic, right? But I think your point is well taken. Look, going forward here, the rest of this year and into the 2021 year, you need to be pretty cautious about what kind of numbers you're using with projections.
And a different way of putting this is that 22% carryover, that's going to take a while for that to disappear. That's going to take some big shock, either in the U.S., a reduction in acreage, reduction in yield, or something in world production that we're not envisioning.
Yeah, good point. All right, let's kind of turn the corner here and talk a little bit about soybeans. On the soybean side, the key issues are going to be export demand. That's really the main one, and crush demand. And you can kind of guess crush demand is actually pretty positive coming out of those livestock numbers. So we're going to focus on the export side. Here's soybean exports. And again, USDA's got, they did reduce their export number for the 2019 crop to 1.68 billion bushels. The interesting thing is they've really got those exports rebounding pretty strongly into the 2020 crop year and actually pushed them above 2 billion bushels. That's a 22% increase compared to 2019. That strikes me as optimistic. And it really what it boils down to is an expectation that we're going to see a more normal trade pattern take place with China.
Yeah, those numbers aren't that much different than what we saw in 16-17.
Right.
And we had a lot of acreage in 16-17, and so if those 20 numbers materialize, that's certainly very positive for soybeans.
Yeah. So, but again, I think a big if there in terms of the return to more normal trade pattern with China in particular, and what's taking place with China's demand for soybeans. So to kind of summarize the soybean side, 2020 could be the largest crop since 2015. Exports, a little bit like corn, are running below the pace needed to hit the export target. I think it's going to be tough to catch up these next 3 months and actually hit the target. The domestic crush demand's the good news because with still the large livestock inventories, that implies pretty strong demand on the crush side. So that's the good news. Our big concern going forward is that forecast of a strong recovery in exports for the 2020 crop year. Will export demand really be that strong? And so much of that hinges on how rapidly the U.S. And the world economy recover going forward. So let's take a look at the ending stocks projections and the prices.
I think this slide surprised both of us.
It did. Yeah, it surprised me. I for sure, when I was working through the numbers,
I had
here
to look
the
at
last
it twice. I had to look at the carryover number for 20.
Yeah, and so to highlight the part that was surprising us for our viewers, those 3 bars on the right, notice the red bar for 2018 with the carryover at about roughly 23% or so. In 19, USDA estimating that dropping back to about 15%. I think we're both okay with that. That's pretty much where we were at. The surprise was the forecast that we would pull the carryover number coming out of the 2020 crop below 10%. And it really hinges on exports. I mean, that's the key variable there. And I guess our view is we're not confident we can see exports recover that quickly. So we think the carryover coming out of the 2020 crop could be
and
bigger.
if we had 1 to 2 million more acres of soybeans, that's certainly going to increase the carryover. And so there's a lot of reasons why that carryover might be north of 10%.
Yeah, that's where I think it's going to wind up, at least at this juncture. So we're a little bit of a concern there. If you look at the price side, USDA came in with a price estimate for 2019 that I think is about $8.50, Michael, and then for this coming year,
I think it was $8.20.
Yeah, $8.20. A little hard to read. I forgot to put the number on the chart, but it's, I believe, $8.20. And as you think about it, given where we're at, we think maybe an $8 marketing year average for the 2020 crop is possible. So a little more negative maybe than what USDA is. So let's turn and look at some net return projections and some of the budgets and think about this shifting acreage question, which we've kind of been circling around a little bit, Michael.
So in the upcoming slides, we're going to use these terms that are on this slide here. Net farm income, remember, is gross revenue minus cash expenses and depreciation. So that's your accrual net farm income on an income statement. It does exclude operator and family labor and then opportunity costs of machinery and land. We want to take a look at trends in that over time for a case farm to see what 2020 looks like compared to previous years since 2007. Net return to land, we want to use that to compare net return to land to cash rents. When you're doing cash rent negotiations, this is the number that you need to project. We're going to show you a projection for a case farm for 2020. You probably need to do a projection for 2021, 2022 when you're looking at your cash rent negotiations in a few months. But this is essentially gross revenue minus all costs except for land. So very comparable to cash rent. Earnings is the economist's dream, where we take gross revenue and we subtract all cash and opportunity costs. Remember, earnings in the long run are zero. And so you expect to see some red ink and some positive, and that's exactly what we've seen since 2007.
And just for clarity, so from an economist's perspective, earnings is where you earn just enough to keep the asset in place.
Yes. So think of it this way. If you own the land, your land's receiving something similar to cash rent. If you own machinery, that investment in machinery, let's say it's $500,000, you're receiving some kind of return for the fact that you own that machinery.
All right, let's take a look at the chart.
And so if you look at net farm income since 2007, obviously 2007 to 2013 and 2014 to some extent was very positive from a net farm income. Remember, when you're looking at net farm income, we're not subtracting labor from that, and so you have to take that triangle and subtract labor to account for that expense. And so it does not include the subtraction of labor. Then we moved into 14 all the way through 2020, and we've seen quite a bit of variability there, with 2015 the net farm income being negative, primarily because that was a very wet June for west central Indiana, and so that's a little different for other parts of the country perhaps, but certainly for that area of Indiana, that was not a very good year. Yields were down. 2017, very low net farm income. Notice in 2017 there was no government payments. Our county PLC did not have a payout in 2017. You look at 2018 and 2019, these years were helped immensely with the MFP payments. That's why that they have a big checkered bar in 2018 and 2019. And in 2020, we're factoring in some Ark County and PLC payments, in particular a pretty strong PLC payment for corn. If corn's down there close to $3, that translates into a pretty big PLC payment, because remember, the PLC price is $3.70. So $3 or $3.10 or $3.20 is considerably below $3.70, results in a pretty big payment. But if that materializes, then the net farm income for 2020 is going to be worse than what we saw in 2015. So certainly not a pretty picture, but I would like to note here, Jim, and we've got some text here related to that. Our estimate for 2020 does not include possible COVID-19 payments. There's going to be some payments. We just don't know what those are going to be yet, so we can't quantify those and include that in the graph. Perhaps next time we'll have more clarity in what those payments are going to be, and we'll revise this slide and show you the revised slide next time.
Yeah, so far USDA has still kind of working through the details on it. It's a pretty complicated process to try and figure out how to allocate those payments across the various enterprises. So those details have not been made available yet, so we don't know exactly how that's going to be computed. They've got lots of issues to resolve there in terms of allocating across enterprises, and then the details with respect to within an enterprise.
We're going to show a slide here looking at corn versus soybean profitability. It's no shock to the audience that large decline in net farm income in 2020 is largely reflected in the drop in corn price.
Well, let's just take a look at the difference in earnings per acre on corn versus soybeans.
When I was doing mean this winter, I was saying that 2019 and 2020, it looks like it was going to be similar profitability for corn and soybeans. Now I'm eating those words. So one of the results, a very negative result of the COVID-19 is the drop in corn prices, the reduction in ethanol demand in particular, and it just really changed the picture here. And so rather having a similar profitability between the two, we've got a situation in 2020 where soybeans looks considerably profitable. Now, I've said that before in previous webinars that this is the Eastern Corn Belt. It's Western Central Indiana, Eastern Corn Belt. And so out in the Eastern Corn Belt where we're at, soybeans are typically look a little bit better than corn. Compared to Iowa and Nebraska. And so this chart would look a little bit different for Iowa and Nebraska, but I guarantee it doesn't look so different that there's going to be a lot of continuous corn. Continuous corn is going to look real profitable in Nebraska and Iowa. And so it's just amazing, how the COVID-19 has changed this chart.
Yeah, so just to kind of backtrack, when you were doing this chart, say in early January, those two bars were actually pretty close to one another, right?
Yes. Very similar, and it was a slight advantage to corn. When I was doing this winter, maybe a $10 advantage to corn in 19 and 20. As we get more information about the size of the 19 crop, we didn't know that on a county basis until February when those estimates came out. Corn looked a little better than we thought it was going to, but 2020 is where the big change occurred. And this is the same as what we saw from 13 to 18. We saw that run up in soybean acres. And so that's where I come from when I say there could be a 1 to 2 million increase in soybeans with a corresponding decrease in corn. I know a lot of people can't shift acres, but I do think there's some people that have been watching this soybean to corn relationship since mid-March and maybe change their plans.
Yeah, we've been watching it, and obviously as you read some of the press reports, there's been some anecdotal stories about people doing some switching. The economics are favoring that pretty strongly right now. So I do think, in my numbers, I've been using 1 million acres of shift, and you point out that it could be a little larger than that depending on how people view this. So we wanted to give a little clarity to those payments.
Now, these payments, of course, do not include MFP or COVID-19 payments. This is just from our county PLC program. We were recommending that people enroll in the PLC program for corn, so that's what we're illustrating here. The drop in corn price that's expected for 2020, it really increased the PLC payment. Is that enough to offset the drop in corn price? No, but it certainly helps. We'll illustrate a corn budget here in a couple minutes. For soybeans, the payments are not as big for 2020. The 2019 payment's actually higher. This is for a specific county in Indiana, by the way. It would vary a little bit across counties. And this looks really odd at first glance. Jim, I did triple check the numbers. The possible payment for our county for soybeans actually drops from 19 to 20. We have to remember that the ARC County is based on a revenue guarantee. And as you enter new information for 19, you change the revenue guarantee for 2020. And it just so happens that the ARC County payment, possible payment in 20 actually declines.
And I think a lot of people maybe in the last month or so have been wondering, well, did I make the right choice? And we were recommending the ARC County for most people looked like the best choice on soybeans. Even with the drop in prices, it still looks like that's probably going to pan out.
Yes.
In part because of the relatively large payment under ARC County for the 2019 crop year.
Then it goes back to the PLC price for soybeans is $8.40. That's not a very strong price compared to $3.70 corn, and so just that alone always made ARC County relatively attractive for soybeans compared to PLC, and so when I did PLC estimates for soybeans too, just in case somebody enrolled in PLC. Prices would have to drop a lot more than we're anticipating for the PLC program to be preferred over the ARC County for soybeans, and so far our recommendations hold.
Yeah, there you go. All right.
Now we're going to move into a discussion of contribution margin. Look how the contribution margin for corn and soybeans have changed. You're looking at a late January budget to our most recent estimates, and Jim wanted to remind the audience of what the contribution margin is. It's the same as return over variable cost. You might be more familiar with that term, but essentially it's gross revenue minus variable production costs. It's a classic shutdown condition. If contribution margin is negative for corn, you shouldn't plant corn. Now, it rarely, if ever, is. And so we typically,
I don't think we've ever done a budget where it's actually
yes.
negative.
And so that would be very rare. Maybe back in the 80s when corn was under $1 for a while there. There was a time where it was under $1. There might have been the case, but certainly that's typically not the case. But we wanted to make sure we define this term so you more fully understand our budget slides. So looking at corn, looking at late January and May 13th, I updated the budget. I didn't update the cost, but I did update the Ark County PLC payment and then the crop revenue based on Dees futures with a more historical basis. You can see the drop in crop revenue is large because of the drop in corn prices. The Ark County PLC program helps, but it certainly does not offset the drop in prices. So the contribution margin for corn has dropped $70.
And I want to emphasize, and I think you already mentioned it, but let's point out that includes the revised estimate of either Ark County or in this case the PLC payment.
What I did for the Ark County PLC payment is I do, the PLC payment for corn is $65 right now, but we have to remember that's not based on planted acres, that's based on base acres. And so what I typically do for these budgets is I average the corn and soybean payment and present that payment in both the corn and soybean budget. I think that's logical because those payments are based on base acres, not planted acres.
Okay, so good point. And so a bigger payment, but not enough to offset what's happened.
So remember that 281 for contribution margin on corn. If we go to soybeans, the contribution margin, that's actually mid-May budget there. That is a typo. That is a May 13th number. But our contribution margin is $329. That's $50 higher than corn right now. And so, you go back to late January, corn looked like it was at least rotation corn looked like a pretty good bid. Now, not so much. And this just illustrates that even though we've had a drop in soybean prices, that drop was much smaller than the drop in corn prices, and so the contribution margin here declined, but only by $9.
So soybeans more profitable than continuous corn. That probably almost went without saying.
Yeah,
right?
the answer to this is no. At least in the eastern corn belt, it would take some pretty high corn prices to make continuous corn look attractive. At least with the yields that we have in our budgets. Certainly, there's situations where yields are much higher for corn than what we're illustrating here, and that would look different. This one's a little bit more interesting, looking at second-year soybeans versus rotation corn. And so if we had $8 soybeans and we use the budget costs and budget yields, I've got the yields illustrated there in the column headings, we would have to have corn prices above $336 on the high productivity soil to favor rotation corn over soybeans. And so I think in the last webinar or our last two webinars, we've said we're not likely to see a lot of second-year soybeans. I'm changing my tune a little bit on that, particularly in parts of Ohio and the northeast part of Indiana. We could see some second-year soybeans again looking at this slide.
Yeah, and so just for clarity here, when you budgeted this, you did actually use a modest yield penalty on the soybeans, right?
Yes.
So that's built into the budget.
That's built in.
What kind of a yield reduction were you looking at?
Very small. Typically, the agronomists tell me that there's a very small decline for second-year soybeans. It drops off more for third or fourth year.
Yeah.
And of course, it depends on if there has been some fungicide or some need for fungicide in the past or some disease issues in your area. I know the part of Nebraska I'm originally from, disease is a big issue, and so second-year soybeans would not look very attractive to most people there. But certainly in Indiana, the last 3 years, we've seen quite a bit of second-year soybeans.
Yeah, that's right. So, cash rents.
Cash rent and net return to land, that's information important is when you're renegotiating cash rents in the next few months. We probably should next time add a 21 projection to this. That's really difficult to do, but that hasn't stopped us before, and so we'll try to do that next time. But the point here is there's just a large difference between net return to land, so all gross revenue minus all costs other than land, compared to cash rent. And in the past, we've seen that big a difference. That creates some downward pressure on cash rent. We've seen several years in a row where net return to land was below cash rent, but except for 15, it wasn't substantially below. 17, it was getting, it was pretty wide difference there. But when you're looking at 2020 there, and you're looking at a net return to land without the COVID payments, under $100, and cash rent in this situation, just for average productivity soil in west central Indiana of 240, that's too big a difference. I've done some preliminary estimates of 2021. If we just get Ark County PLC payments in 2021, trend yields and using the projected prices, it's down around that $100 to $125 for 2021. That's too big a difference for cash rents to be stable.
Good point. Although I have to say, to some extent, we learned this lesson in 2018 and 2019. In those cases, the MFP payments came in and really supported cash rents.
That's a very good point. It depends on how big those COVID-19 payments are, but it just shows you, even if we had $50, we have no idea what those payments are going to be, so I want to clarify that. But just for a number, even if we had $50, we'd still be substantially below cash rent. So I think even with fairly large payments, we've got some downward pressure.
Yeah, we wanted to bring that up today because we know, although it's a little early to be negotiating a cash rent for 2021, a lot of those discussions will be taking place here within a month or two. Historically, I think people start having those discussions, truthfully, anytime after planting season's over, and a lot of times in July and August. So as you're thinking about that, it's time to, at least in the back of your mind, be thinking a little bit about those cash rent negotiations and what's going to take place.
And we have on our website some information related to flex rent. In fact, we have a publication that compares share rent, flex rent, and cash rent, compares that historically, what those have done. This is probably a good year to be thinking about flex rent.
Yeah.
Because that usually when you do flex rent, you decrease that market cash rent somewhat and call that a base cash rent. And then if prices or yields are really high, the landlord can capitalize on that. And so this is not a terrible year to think about flex rent.
And the other thing to think about with respect to cash rents, which you and I were talking about earlier, is the fact that one of the things that's probably going to put some downward pressure on cash rents this go around is the erosion of working capital that's taken place the last 5 years. Coming into the downturn, many farms had a pretty strong working capital position. We've really eroded that pretty substantially in many of those operations the last 4 or 5 years. As a result, we don't have that cushion to support cash rents, and probably going to create more downward pressure.
Yeah, when you looked at Farm Management Association data, it was not uncommon back in 2013 to see a lot of people with current ratio, current assets divided by current liabilities, over 3, meaning you had 3 times as many current assets as current liabilities. That's a very strong working capital situation. Today, it's not uncommon at all to see quite a few people below 1.5. And so there just isn't that cushion there. And another thing I should point out is over the years we have developed a spreadsheet that can help people look at these cash rent negotiations. And so I encourage people to look at that spreadsheet. Plug in some of your budget information and some of your price forecasts and see how much difference there is between net return to land and cash rent. And just ask yourself, is that too big a difference? Can I withstand that big a difference and still have a comfortable level of working capital?
Yeah. But it's a different situation than we had 3 or 4 years ago.
Definitely.
All of a sudden, we don't have that opportunity. And what you were mentioning that spreadsheet, you and I did a number of those workshops over the last several years. One of the things we literally worked through was how much of your working capital are you willing to allow to decline for the right to continue farming this property in the future. And if you don't have the working capital to give away, that discussion changes quite a bit, and that's, I think,
particularly when you're looking at over $100 to $150 difference between the net return to land and cash rent.
Yeah. So With that, I think we're going to wrap it up. Our next webinar is scheduled for June 12th. That'll be following the USDA's next World Ag Supply Demand Estimate report. So we'll have updated estimates from USDA and look at some updated profit projections, shed a little more light on this cash rent situation, and maybe talk a little bit more about how you might use that spreadsheet in terms of helping yourself make a decision there. So with that, on behalf of the Center for Commercial Agriculture and my colleague Michael Langemeyer, I'm Jim Mintert. Thanks for joining us today.